think this myth would have been so like this conversation would have been a lot harder to have in 2020, like before the biggest boom we've ever seen. Maybe not the biggest boom we've ever seen, but a massive boom. It would have been a much harder conversation to kind of argue, a harder point. So I think after seeing the Australian state, the country grow 21%, you have to agree that you can, if you bought in a cash flow area, then you're going to have done pretty well. So I guess the main thing is, what are we talking about here, right? We're talking about the typical go out super duper regional and get cash flow only, or go out there and buy blue chip, buy a unit in Bondi, buy a house in Bondi, have negative gearing, and then the capital growth will grow and you'll be making money, right? There's generally been two camps. And what we're saying is you can kind of merge the two of those together. One thing to mention as well is rental yield is not enough. If you just have a pure rental yield type asset, right? Let's just say you've got 6% and you're bringing in $5,000 a year. Okay, amazing. $5,000, well done. You're going to have like 20 of those properties to be able to go, right? Like to be able to retire, you need about 20 properties that bring in 5K net positive a year.
Assuming you don't pay that under debt, but yeah, it depends on how. Yeah, but yeah, I agree. It's tough.
How are you going to do that? You can't do that type of purchase anymore. There's no serviceability that's going to allow you to buy 6 properties. Now, if you start to go into the commercial space and start getting low doc and no doc loans, yeah, there's some possibility around that. But I guess we're just talking less sophisticated, everyday mum and dad property investors. The other one is blue chip, right? Do we go blue chip? I just want to buy Bondi Beach. I know everyone's always going to want to live there. It costs me, I know it's fine. It's 10 grand, 20 grand negative a year. That's absolutely fine because it's growing in value. One thing to also focus on it for that is how many of these blue chip properties can you afford? How many $10,000 and $20,000 can you have before you go broke? So this is where you need to kind of have a bit of a balance of them. And one of the big things that people are going to, talk to me say is like, no, but I'm saving money on tax. So I'm doing fine, right? Like I'm losing $1 here, but the government's giving me back 30 cents. So I'm sweet. I don't need to worry about that. But I guess kind of think about that for a little while. Like, is that return what you need? So yeah,
what are people's thoughts on negative gearing? Do we not the
Oh God, do we? Yeah, is that a myth? No, I mean it works. It works. It does do its thing. And the thing is, we've got Jeremy Inazelli, an amazing accountant. I'm sure he has some things to say on the topic. Watching right now. So anyway, that is mine. I believe that you can have capital growth and you can have cash flow as well. This is one of the things that I think is the most important for people is it is very hard to align your money, your serviceability, your borrowing capacity, your ability to spend the time, energy, and effort to go out there and find a property. So if you're ready to buy a property, what is a bigger risk? Buying a property that you're going to hold for the next 30 years because you're building out a portfolio that's going to sustain you into retirement, or just trying to time them up and then like not buying it and waiting for the crash, right? We're waiting for the crash. We want prices to dip. I literally bought a property off someone 3 weeks ago and they said, we're waiting for the property market to crash. You guys are idiots buying this. I negotiated it down $20,000 off the purchase price as well. And so I already got a discount off the price. And they're like, no, we're going to be buying back in 2 years after the market drops 30%. And it's like, but what if it doesn't? You've just put all your eggs in this basket of it crashing. And then what will happen is in 6 months' time, your partner will lose their job. You'll have a baby. Your deposit will get spent on a holiday. Like then you move property to the less important things. And Jeff and I were talking about this actually just today. Like there was a big boom and hype about property investing when we created this group, right? We were just going through one of the largest booms, and maybe that's why Jeff and I were saying, like, we're starting to see the group kind of slow down a little bit. There's a lot less people joining at a ferocious pace that people have been before, but it's because I invest in property for a 6% growth rate. Like, I don't buy property for a 20% growth rate year on year. I just want my average. I just want a nice little steady, 5.8, 6%. That's going to get me to my passive income goals. So I don't need these crazy things. But anyway, that was
It's
going
nice.
on.
It's nice to have that
Bit of
though. I mean,
tangent.
if somebody said,
Definitely,
yeah,
it's definitely nice to have it.
yeah.
Population growth means capital growth. So this is the theory, right? If an area is growing in population, that means there's more demand for it, which means prices will go up, right? This is one of the greatest marketing tools banded around, and really, it's just implying strong population growth gives you future capital growth, but in its simplest form, it kind of passes the test. Yeah, more people are coming into the place. That means it's going to work, right? Um, and I guess most people think population growth is a key indicator of demand. So if the population is growing, there's going to be huge demand. But I guess the way to view population growth is more of an indicator of supply. So if there's a strong population growth, there must be a lot of available properties for people to move into. So that's one of the things that I wanted to talk to is it's not actually, so just think of a different market, right? Think of Bondi, for instance. No more people, not really many more people can move into Bondi,
They
but
can't. No.
that still the houses are continuing, like the values of the properties are continue to going up. What I am going to do is share my screen with some data that I've pulled for areas that have the largest population growth. So looking at population growth over an SA3 level, a suburb, Queensland had a whole heap of people moving from, you had a whole heap of people moving from Melbourne and Sydney up into Queensland. That's valuable information to know. But as soon as you start to drill down deeper into the suburb level, it becomes a lot harder and a lot less useful for you. So the only way the place can, an area can grow is if there are more dwellings that are being built. So people don't just, they don't just move into the street and just hang around or move into cardboard boxes. There needs to be a vacant place for them to move into. So I wanted to share some data with you, and I imagine you probably know some of these areas, Jeff, but I can't imagine it's an area where you would invest too much.
Is it the area we used to sort of have not poke fun at?
Poke a bit of fun at.
No,
No, so
yeah.
this is my pulled straight from projected population medium series by SA2, SA3, and SA4 in Queensland.
Go bought out the big guns.
And these are the suburbs that have the total growth percentage. So the suburb with the most predicted growth percentage. Now, obviously, it's coming off a low base, 4,000 to 126,000. So the government has created this thing called a growth. I don't need to a growth corridor, but that growth corridor is not really a growth corridor. It's a supply corridor.
Yeah.
What do you think, Jeff? What do you think of that?
Yeah, I tend to agree because it's a sort of thing that that you do hear on various sort of marketing campaigns about population growth and all that sort of thing. And typically in a lot of these areas they'll be building very cookie cutter newer stock. I'm not saying Ripley is all brand new house and land packages, but if it's not, well, I suppose if people are going to move there and there isn't, and you're talking tens of thousands of people, it's not feasible for them to be existing properties. So there needs to be, I suppose, an expansion of supply of houses, I think.
Yeah. So this is the absolute winner with projected growth of 102%. We have from the beginning to the end, we've got 25% year-on-year growth. Ripley. And here is what is in Ripley. So is this going to be an area that you're going to invest in? there is a whole heap of green fields everywhere. There are new developments getting built as we speak all over the place. There is no way that you're going to want to put some money. Well, there's no way I'm going to want to put any money around here because there's no tightening, there's no supply constraints. All there is more and more supply getting built out. So eventually, what will happen is Ripley's going to get super built out, and then eventually, over that 40 years, it will get to a point where people will actually, prices will get to a point and they won't be able to build anymore, and then it will go crazy.
He's one that you love to hear, like Uncle Jim or Auntie Jan talk about property. I bought this property and it doubled in 6 months or whatever it is, or 6 years, and they talk about. They say as if they were able to predict that's what happened. So I think rather than say that this is a complete myth, because yes, it can double, I want to say property may double, because I can show there's multiple examples. So I'm gonna sort of rip through this one pretty quickly, because I want to get to Q&A and really just sort of give and also see the case study. So I'm going to share a screen because here's something I prepared earlier.
Get the chicken out the oven, guy.
Yeah, yep. So if we have a look at the let's have a look. So I'm not going to run through it. As in, I'm not going to do the timing. Like, so I actually have to remember the time periods. So I'll go through to here anyway. Let's have a look. I'm gonna share. This is what goes on behind the scenes. So here's my data
questions. Look how much Jef prepares.
Yeah.
And then these are my questions for Jef. Why does Jef look so good in board shorts?
Yeah. So if we look at for Sydney, so good old King. So everybody says, well, not everybody, but there's some people in the group that poke a bit of fun about Sydney being king. And so I looked at that. So from 2002 in Sydney. So if we go down, I'm going to sort of try and pick this out. So look at the start of 2002. So Sydney was absolutely out front. It was kind of miles ahead of everybody else, just over 403,000. And this is non-inflation adjusted dollars. And if we go 10 years from now to 2012, we sort of see Sydney at 602,000. So that, I don't know about you, but that's certainly not, so double 400. Apparently I'm not a maths teacher. And I said that in a comment. If you know, you know. But so it went up 50% roughly from 400,000 to 600,000. You can sort of see that Darwin has almost caught, Darwin pretty much did catch Sydney. So we sort of see that there. So that's, I suppose that clearly it hasn't doubled. And then of course we all know what happened then. I will play this out just quickly to sort of show what happened to Sydney. Look at that. In 2012 alone, absolutely sort of rocketed ahead, and Darwin just was really so look at that.
So what made Sydney do that?
Yeah, it's an interesting question. There's people that sort of, so we look at in 3 years, so it went from 600 to 900. So you pretty much saw another 50% growth in the space of almost 3 years. So I think Sydney being Australia's largest capital city, which is almost about to be overtaken by Melbourne in terms of population, and we know that population doesn't equal capital growth. Yes, we just busted that one. But being Australia's largest city, the economy and just the scarcity largely of land in Sydney, and it has sat there for 10 years and not done too much. So you sort of, a lot of property will generally move in cycles. That's not to say that because I know that Perth I've got an example about Perth. So my thesis is that there was people that were sort of saying, well, this is now looking quite affordable. It hasn't absolutely sort of boomed too much, and it was kind of the perfect storm. Interest rates were going down, which we sort of say going up doesn't increase, but access to capital probably just got a lot easier. People's wages increased, so it was kind of sort of somewhat the perfect storm. So I would say macro conditions. Yeah, David's asking this.
Oh, there you go. Do you think there
could be a boom 2.0 in a year or two? Too many variables.
Well, let's just go back. I mean, I'll share my screen again. Like,
Yeah.
let's just go back in history and see what it actually looks like, right? So this is July 1992 to July 22. And these are the last booms that we've had. So we've had a resource boom from 2004 to 2011. Property prices from that period went up 215%. We had a dip down here for the GFC. So you'll see we had a GFC. It went down 7.5%. And then it started to climb up again. And then it's slow. Like this period here is, just boring and stagnant. Prices just aren't moving.
Consolidating, I suppose. Yeah. Yeah.
Yeah,
Maybe a little bit boring, but
consolidating, but like you're not really gaining much. And this is why you need to have properties that look after themselves, right? That wash their own face, so they've got capital. So you've got some money coming in, so they're looking after themselves. But then you can hold them for the long term, because if you hold them for 10 years, look what we've got here. We've gone from, what is it, 400,000? Oh no,
I love it how
600,000.
they pointed out that Labor loses Tony Abbott elected PM, but there's no other. Oh yeah, they did mention coalition wins. There you go. Okay, so it wasn't. Yeah.
Yeah, there you go. But this is where you'll see again the RBA announces cutting the rate from 4.75. But you didn't see a boom, like they cut the rates. You didn't see a boom of properties
Not straight
moving
away.
straight away. And then there was another one. Investors reach a record high proportion of mortgage activities comprising 46% of mortgages. And then they put a cap on interest only loans. And that's where you saw the Sydney boom come off its peak. And then it was a bit slow for a couple of years. And now we started our COVID boom. So, I mean, what is this going to look like? Is it going to be a downturn like this? Is it going to be a downturn like this? Is it going to be a downturn like this? Is it going to be a downturn like this? There's no answers.